We just got that sweet $1,400 from Uncle Sam. Thanks, government. Wear Lambo. What's going on, traders? Welcome to the channel. My name is John. That's Groot. We trade options here, but we need to talk about things to do with that stimulus money. It is burning a hole in some pockets. We got to figure this out. So, got 5 ideas for you. First off, before we even consider anything else, this is literally the most important thing ever. This is like a mindset thing, but also it will help you, I promise. If you have credit card debts, any outstanding debts, rent, things that are really important that you are behind on, take care of it now. Food, anything, family, do it. Because you need to think about it this way. It is always going to linger on the back of your mind. It's going to affect your future decisions. And more importantly, if it's a credit card and you pay that off, that's a 20% gain right there. Just instantaneous 20% gain. And if you're not thinking about it or having to worry about it, man, that's going to make your day so much better. You're going to have more clarity in your decisions. And that's really, really important. So please, that's a bonus tip for you. It's not even part of this here. It will always beat the potential gain that you could see in the market. No matter what, it's guaranteed gain if you pay off that card. All right, so 5 things. We're gonna go from slightly lower risk to much higher in risk, and we'll talk about it. Number 1, index funds. Index fund investing, especially if it is with a low fee, low cost index fund, can really help, especially over the long term. Generally speaking, when you're in an index fund that tracks a big basket of something, that generally has less volatility and over the long term can grow significantly. So as an idea here, you're going to be looking at things like the SPY, QQQ, VOO, and VTI. And what these do is these track the overall market in general, and usually speaking, they've seen a typical average return over a really long time of about 8%. But some years are better than others, and some are really poor years too. So you just got to be able to deal with that type of volatility. But generally speaking, there's less volatility in these index funds. Number 2, dividends. Dividends are great. Think of them as like little paychecks you can get usually quarterly, sometimes monthly, within a time period. And it's almost like you're participating in the earnings of a company. They basically pay you back out. What you'll see is an ex-dividend date. You want to be in the stock before the end of the ex-dividend date in order to qualify for that round of dividends. So always look at that. But some key ones from an index fund standpoint are DGRO and VYM for your index funds. Some individual stocks that are great for dividends would be ones like MO, M-O-T, and also O, which is Realty Income. That particular one pays out monthly. Number 3 is individual stocks. So the way to think about this is individual stocks can be great, but they do carry single security risk. And an example would be if a company looks great on paper, but turns out they've been lying the whole time or they're very fraudulent. Well, that's single security risk that could go to 0 or half of its value. Something to bear in mind, especially if you plan to put all your eggs in one basket. Now, me personally, I am a believer in growth stocks, especially really high quality, high flying growth stocks. There is some risk involved, but the potential reward does tend to outweigh the amount of risk I'm willing to put up. So keep in mind, for everyone that's different, so do your own research. But for me, I'm looking at stocks like Tesla, like Palantir. And then, another idea I have is that in the next about 1 or 2 years, we're probably going to see a big upgrade cycle in Apple products. So I do think Apple, AAPL, will have a good amount of performance. Some of my family is interested and invested in the stock. So it's one reason I'm putting that out there. And I do agree with that aspect of a stock that they're interested in. Okay, next is stock options, and basically stock options are a derivative of the underlying stock, and this can get a little trickier. It's definitely riskier, but in essence, when you take a stock options contract, you're controlling 100 shares of that stock, and usually it's with less capital than actually buying 100 shares outright. However, there is a lot of nuance to this. It can get a little wild, and Groot and I, we like to trade stock options, especially for income, and then we'll use that income almost like little mini dividends basically on a weekly, monthly basis to put it into growth stocks or other strategies that can help build wealth for us faster. But keep in mind, not for beginners. I definitely recommend studying up, maybe working with a paper trading account to get the idea. And really with stock options, there is a multitude of strategies you can employ. But the reason I'm interested in this is I like that with regular stock, you can only make money if it goes up, or you lose money if it goes down if you're buying a stock. But if you're trading options, you can make money if it goes up, if it goes sideways, or if it goes down, depending on the strategy that you set up. But the bigger thing I like to do is make sure I also keep my risk in check, and you can shuffle your risk accordingly, and that is very helpful, at least with the type of strategies I like to employ. So keep that in mind. Stock options can be great, but they can also be a double-edged sword. Okay, the last one, number 5, super risky, is going to be futures trading. And I only recommend this to anyone who has had many years of experience in the market, watching how stocks and markets and sentiment and the ebbs and flows of charts and fundamentals. That's really, really important here. But it is nonetheless an option to consider, because the beauty with futures is that you are not stuck with PDT, which is pattern day trading rules. I mean, you can start with as little as $500 to $1,000 depending on the broker, but keep in mind the risk is heavy. So as an example, the E-mini S&P 500s, those trade per point. Those are $50 swings in the account, meaning if the S&P goes up, $1, that's $50, but say it goes down $1, that's minus 50, and then if it goes down $10, that's already $500 down that you could be in. So keep that in mind. Markets move fast in this one. It's almost one you got to watch like right away, stay on it pretty much all day, and I don't like that form of trading, at least in the moment. I really like to have my time, spend it elsewhere, and make sure I'm just utilizing my options trading. So big question is, what am I doing? Well, of course I'm going to trade this. I want to multiply this money. My goal with the $1,400 is I would like to use it to purchase things that are well beyond just the $1,400. And so as an example, I need to get new tires for the car soon. So I want to be able to utilize some trading to make sure I'm not paying the full amount, or maybe I can earn them for free. And then also I need other things like stuff around the office equipment, maybe some workout equipment. I'd like to get a new bike. Don't tell the wife. And so by earning that through trading is not only important to me because I'm a believer in it, but also I think it'd be great because I'm going to start an account totally fresh. You guys can just kind of follow along with that, and we can work from there and see how this goes, see the returns, see how the trading goes. And my main hope is that people learn from that in the future. So go ahead and subscribe, hit the bell. I'm going to give updates every week on the Stimmy account. And what you're going to want to do is watch this next video that's going to talk about why I think Tesla could be a big growth stock. And that's a big part of my long-term portfolio.